Cloud. All right. Good afternoon, everybody. My name is Matthew Friedel. I am co-founder of Milwaukee Venture Partners. I also have a teaching position at the University of Wisconsin-Milwaukee, where I run a innovation incubator that helps startups. Zach was kind enough to come to campus last week and give a similar presentation related to this, but it's all kind of intertwined with respect to startups and how you value them, especially in the early stages. So I'm going to let Zach introduce himself and then let him go through the slide deck. If there are individuals who are not watching this video but are actually online with us right now, I'll be monitoring the chat. Feel free to pop in a question if you'd like. And then as Zach kind of goes along, I'll offer some perspective on how we look at companies and how we value them. But already of seeing this presentation, I know that it will be of significant value. So Zach, I'll let you go ahead and introduce yourself and then go through your slide deck. So go ahead, sir.
Okay, sounds good. Thanks for having me, Matt. Can everyone see my presentation here?
I can, yes.
Okay. So yeah, my name is Zach Learman. I'm a CPA with Wipfli LLP, which is a regional accounting firm headquartered in Milwaukee, Wisconsin. I'm a manager in the valuation and transaction services portion of Wipfli. So I perform valuations with a focus on privately held companies that are early stage, including their complex financial instruments that are typically associated with venture capital or private equity backing. So a lot of my valuations focus on the regulatory aspect, whether it be tax reporting such as 409A valuations or financial reporting for audited financial statements under ASC 718, ASC 805, and ASC 820. So my contact information is here. And yeah, let's get underway with this presentation. Quick disclaimer, obviously this is just for educational purposes. Please consult with your accounting or legal professionals with any decisions you're making. So just a quick overview. Again, this is the original presentation was geared more towards founders, and that's sort of the didn't really change much of the original presentation. So it's a focus on founders and what they need to understand about valuation, especially in the early stages. Tried to boil it or keep it very high level and boil valuation down to really three main concepts. So I'll take you through a more abstract view. It'll remain abstract throughout the entire time, but we'll kind of apply those concepts to venture capital specific. And then we'll go through kind of communicating value and some of these factors and how they play into valuation at the early stage. And then we'll open it up for any questions. Although feel free to pop in with any questions as we go through this, make it more interactive. So first, again, getting to what is value from an abstract view, really want to keep this very high level and break value down into three main components. First, we'll discuss what is value in the context of a business or a business enterprise. One, it's got to be transferable. Are you building, or again, this is addressed more towards founders, but is the founder building an enterprise? Is this something that's separate from the founder, or have they essentially created something that's more or less a job? For instance, if I were to run my own valuation practice at the beginning stages, if I don't have much staff underneath me, really all I have is I've created a job, not really a enterprise that I can transfer aside, like apart from myself. I would probably have to come along with the sale of my book of business to whatever firm I sold to, and I'd have to remain as an employee. So the idea here is with a business enterprise, it's got to be something that we can transfer beyond ourselves. Number two, it's got to have some type of economic substance. So this gets to the concept of commercial viability. Is the founder's idea something that will achieve commercial success in the future, or has the ability to? And then number three, and where the focus of this is going to be, is on risk and return, and how value is driven by both of these concepts. Basically, are the potential rewards from, or the benefits of ownership, do those benefits and the growth of those benefits outweigh the risks in achieving those benefits? So if you have a finance background, you're probably familiar with the Gordon growth model. Typically, it's applied to dividends. It's a perpetuity calculation where it's trying to derive, the cash flow to equity holders in the form of dividends, applying a constant growth to those dividends, and also assessing the risk of achieving those dividends to arrive at the value of a company. So obviously, that in and of itself isn't directly applicable to venture capital. However, the key concepts there can be applied and are often applied in the valuation world, where we kind of again, we're taking a step back, taking a more abstract view, really boiling value down to three different things. That's your free cash flow, eventual free cash flow, which would be your benefits of ownership, right? The cash you're deriving from that investment. And then this perpetuity calculation is just simply taking a required return, whatever that may be. It might be in the context of enterprise required return, such as a WACC, a weighted average cost of capital, or a cost of equity. But it's essentially the required return based on from that investor's perspective, less the anticipated growth rate. Now, obviously, this growth rate's always got to be less than the risk you're taking on. So the higher the growth, the higher this risk goes up to maintain this relationship. But it's a present value calculation, and it can virtually be applied to all valuation concepts, including multiples. If you think about a multiple, it's really just the inverse of what's called a cap rate, which would be this R minus G. That's your capitalization rate. And that's really all a multiple is, 1 divided by R minus G. It gets you to the same answer, essentially. So that allows us to understand that multiples and valuation itself are driven by risk versus growth, or risk versus return, right? And risk is often measured quantitatively through some type of required return, typically based on interest rates. So now applying this to venture capital, again, it's still abstract. We're not going into a full DCF here, but really a discounted cash flow model can be collapsed into this view, essentially. So from a venture capital perspective, and we focus on the concept of free cash flow, especially at the early stages, we know there is no free cash flow, right? Free cash flow being the remaining cash after all operating cash outflows. Other definitions might be no PAT, net operating profit after tax, less invested capital, being working capital investment, and capital expenditures, fixed asset investment. That would be kind of the best definition of free cash flow. From a venture capital perspective, none of that exists yet. Sometimes, especially at the very early stage, at an angel stage, investors are making these investments in a company that might be pre-revenue. So really this revenue or your free cash flow margin is way out in the future. Generally, a lot of times after your exit, even most venture capitalists are looking at an exit at around 5 to 7 years, maybe once these companies are achieving break-even cash flows. That's pretty typical for venture capitalists. Angels might leave even before that, or along with the venture capitalists. But essentially, that's way out in the future. And right now, free cash flow is highly negative as the venture is going through a cash burn. And so really, how is the VC firm or the angel investor going to assess that potential benefit way out in the future? Well, they're going to look at unit economics along with total addressable market. So a total addressable market, they're going to look at how big this thing could grow to. So how big is the problem that this thing is solving, and what percentage of that market could this venture possibly take? And then they look at unit economics along with that to, gross margins, variable costs versus fixed costs, trying to determine what a potential free cash flow margin might look like at scale. And again, VCs have a pretty specific holding period. They're really trying to get to some type of sale or IPO event after the venture has gained a significant amount of traction. But generally speaking, they're going to be at or either low cash flows, break even, or maybe even negative still, even at IPO. Now looking at required return and its effect on value, the higher the risk, which is again, it's represented, or risk is represented by a required return, which is typically in terms of a annualized interest rate. Most academic research suggests that venture capital pre-tax required returns are usually between 20 to 70%, depending on the stage. And there's a slide in the back that kind of goes over by stage what academics kind of put required returns, again, pre-tax returns for venture capitalists. 70% is kind of the higher end at the early stage. And there's also a pretty cool, actually, I'll just take you back to this chart. So I have a data table here that kind of assesses a holding period along with the multiple on invested capital. And these are the implied annual returns that it takes to achieve those. And then this is some of the academic support for where required returns are from a startup through bridge to a public offering, kind of what the venture capitalists are looking for in practice. And that's so that's kind of there for your viewing pleasure later on. So obviously with early stage companies, they have a high amount of failure. There's another slide in the supplementary section that kind of shows that about 75% of companies that receive their first financing round, typically a Series A, about 75% of them will receive a one times gross value multiple, which is really just the return of capital. So of the invested capital, they're receiving 1x or lower. So basically, that would be a failure scenario if you're not getting all of your invested capital returned to you. So that there's different forms of empirical evidence out there that show this, but it's usually pretty consistent. About 75% of venture capital backed companies fail. And then of 40% of them, or yeah, around 40 to 50% of them, based on some of this research, return zero capital. So it's a complete loss for the VCs. I guess a relevant or a recent example might be the FTX collapse, if you've been following that. And that was a pretty late stage venture capital backing, obviously. So how do venture capitalists, and again, I'm kind of preaching to the choir here, but how do venture capitalists deal with some of this risk? Well, it's usually in the form of some type of convertible hybrid instrument. In later stages, it's usually going to be a convertible preferred stock round, in which they have liquidation preference. At earlier stages, you might do this with a SAFE, a simple agreement for future equity, or a convertible bridge round that converts at some type of discount to the next financing round or the next equity raise. That liquidation preference allows the VCs to be ahead of the founders and any holders of common or employees with stock options, allows them to sit ahead of them in the capital structure stack and get their return of capital in the event there is a problem or a sale scenario where they really don't meet expectations, but they do get some amount of capital back. VCs are basically first in line. So that helps offset some of that risk they're taking. And then also just from a fund structure, the funds are going to employ a barbell approach where one or two winners are going to make up for a majority of the fund's losers. Most will, just statistically speaking, be either a complete loss or a very minimal return of capital. So you're hoping that a couple 1x or a couple, 5x to 10x returns on your capital will make up for the majority of losses. And then growth. This is going to be obviously one of the main driving factors behind your decision to invest is what's the growth potential. So still looking at the total addressable market, but it's looking more at the rate of market penetration. How fast are you going to achieve that market share from your total addressable market? Some of the things that go into this are network effects, disruptive innovation. And it's important to remember that for founders and investors alike, scaling is a balancing act where growing too fast can also lead to failure. You might rush to release a product that's just not quite ready. You had maybe one shot with your customer base to get it right. You have other competitors in the space that might be working on the same type of solution, and you really only have that one shot. If you are growing too fast and you decide to release too quickly, that can lead to a situation where you had your shot and you kind of blew it. Other examples might be just as you scale, you have to take concessions on your hiring practices, and you might hire underqualified individuals as you really start to scale up, and that could impair your product quality, for instance, or your customer service. Again, something that could lead to eventual failure. And then I'll take you back to one of the supplementary slides to kind of show this exponential relationship that growth has with value. So what this chart is showing is it's basically graphing these inputs. It's holding all of the blue inputs, being your annual recurring revenue, a free cash flow margin, a required return of 40%, and then your growth rate is the only variable that's changing. So that is changing along the x-axis here. And then we can see the revenue multiple is a function of, we're looking at an implied free cash flow margin of $150. Again, this is a very simplistic view, but this allows us to understand the relationship between growth and value, and kind of this exponential relationship that you get into when you start to look at very high growth, where that cap rate, the R minus G, starts to approach zero, or a very low percentage, 2%. You start to get these very high multiples, as you can see, and then you can see these changes in growth are going to cause very extreme changes and fluctuations in value. And the way to a good practical example looking at this is just in the last year, with 2022 kind of being a bear market thus far. We've really seen growth stocks take a hit in the public markets. So if you follow the triple Qs, the Qs, most of those are going to be very high growth companies, typically SaaS oriented. And we see that, I mean, I think Meta, for example, is down like 70% or so on the year. And a lot of that is, again, the rising rate environment that affects your cap rate. And then just anticipated growth is slowing, right? So any small change in those assumptions is really going to impact high growth firms. We see on this exponential scale here, when you're not a high growth firm, maybe a value play, a value stock, that's where you see less impacts from some of these market forces, being rising interest rates and slowing growth. If slowing growth in the tech sector doesn't really affect Coca-Cola too much. They're going to have kind of that constant achievable growth, and their free cash flows are already pretty high. They're a mature company, but those growing companies, that's where this is going to impact the most. I'll take you back to so that was kind of taking you through, still remaining quite abstract with value. Now we'll go to kind of, this again is addressed more to founders, but how they need to be communicating their value to investors. So really it comes down to your story as a founder. What's the problem you're trying to solve? What's your total addressable market? Is it a large market? Obviously, solving a small problem that doesn't really affect a high number of people, it's not going to attract capital from VC. I'm assuming most of our audience understands that concept. VCs have that high failure rate, that need for high growth. They need something that's a large market, and our venture is going to grow into that market very quickly. It's also important for founders to understand their competition. Who else is trying to solve that problem? And it may not always be that obvious. A lot of founders think that they're doing something that's extremely disruptive. Therefore, they're creating a market, and they have the mistaken belief that they don't really have competition. I think we all kind of realize that that's not the case. There's always somebody out there working on some aspect of your problem, even if it's not the same exact problem that you're trying to solve. They might be solving some aspect of it that is a good near-term solution that's going to cut into your growth, cut into your ability to expand margins. And then the biggest thing, and I think most people on this call might be able to attest to this, is the founder's vision the right vision that's going to solve that problem? What's the VC's or the angel's faith in that founder? There's, most venture capitalists that you talk to or angels, a lot of them are just putting out their best guess of the future. All of their investments are highly speculative. Again, because everything is driven by the future, and there's a lot of variables at play. So a lot of the decision comes down to VC's assessment of management and the founder team. Are they the right people for this job? And then just going over revenue models, assuming a lot of people kind of understand this concept, but the different types of revenue model, what I would call non-recurring versus reoccurring versus recurring. So my examples here would be selling durable goods, such as, let's keep this in the software industry. You could be the one selling the hardware, selling the computers, versus maybe software consultants, versus a SaaS, a software as a service. And as you can see, kind of have the different factors that go into each, with the higher multiple being applied, generally speaking, to the subscription service or subscription model, where you've got recurring revenues that really don't take a high amount of variable costs to achieve. Obviously, you're still going to need to scale these businesses, and there's going to be ongoing costs and additional somewhat variable costs as you scale, but it'll be at a far less extent than a company like a software consulting company, where the revenues are reoccurring, but there's still a high variable aspect to it, where you still have to have the headcount to make those sales, do the work, versus a subscription service where you really have like a development team that's making the software. It's not a linear relationship with sales or revenue. It's going to be, okay, we need to build out this new feature. We need the headcount to do that. We need to do ongoing maintenance and updates to our software, but we really don't need additional headcount to make new sales. So the variable costs are less in a recurring model, and that results in an easier to scale business. There's, again, the capacity issues being that you don't need as much headcount to produce more revenue, and there's just less ongoing investment, and there's a far greater margin expansion potential with recurring revenues versus reoccurring or non-recurring, where there's still going to be a high amount of variable costs, especially on the manufacturing side. You think about, they have to get the inventory, they have to get the headcount to produce that inventory into a final product. They have to have everything else that goes into the recurring model. They have all these additions that cause a highly variable cost structure relative to a reoccurring or a recurring model. And with all those things, that's going to impact cash flow. It's going to impact the ability to grow. It's going to create risk in your business model. And again, those three factors are kind of the driving force behind valuation and multiples. And then this is our last slide before questions, but this was communicated to founders in the original presentation, just making sure they have a good understanding of where they are in their journey, having a realistic expectation for their value and what they're asking of their investors. They might have a multi-billion-dollar idea, but it's really only worth that after execution, going through from idea or concept phase all the way to getting this product scaled and achieving that market share that they were anticipating. So in present value terms, there's a lot of risk in terms of execution and just all these future variables that are unknown that reduce our probabilities of success, and is really going to, as you can see on this chart, risk remains really elevated. And then there's certain inflection points or milestones where risk really starts to come down and the company starts to gain traction, and their value, represented by the blue line, really starts to inflect upwards. And yeah, that's opening it up for questions then.
Zach, can you go back to that chart and can I chime in a little bit?
Yep.
So every angel group and every VC group values companies a little bit differently. And obviously the discounted cash flow model is used, across a whole bunch of different businesses to evaluate, what is their intrinsic value and what are they going to be worth in the future, and then you can assign a value to it. We live, at least for Milwaukee Venture Partners, in that pre-seed and seed phase. So the question is how do we value those particular companies at that point? And you made an astute point, which is the first thing that we're looking at is the founders. Do we feel that they can not only execute, but potentially pivot, if they hit roadblocks with their product or service? This happens all the time. And if they're not able to attack, if they're not able to pivot, that's an issue. And that's why some of those ventures potentially fail. So what we normally like to look at, or at least what I like to look at, and I think my fellow angels do as well, is kind of that second block going over into that third block with the first product. So if they have some product market fit, they have some MVP out there, and they're generating even a small amount of sales, that's demonstrating that somebody's interested in your product or service. Then the second question is, can you and your team scale that at some rate? And now you can start to put some levels of multiples. In fact, the chart you showed with the multiple of revenue versus the growth, I think is an important one, because the value that you're placing on your company versus how much revenue you have coming in versus how much revenue you're going to have in the future is a very basic kind of like measuring stick that we can look at. So we looked at a deal where it was a $10 million valuation with $1 million of current revenue coming in the fiscal year. So you can do a 10 times sales multiple. Yep. The challenge with that was when we looked into the future, and this was a food company, and what they had sold for, what the exits were for comparables, the multiples of that were not 10. They were like more in the order of 2 or 3 times sales. So not only would they have to grow incredibly rapidly, but they would have to capture a huge amount of market share. Now, they were obviously generating revenue. They were successful. That's a pretty huge hurdle to jump over, given the fact that it's a food company. I mean, they really have to scale that product. So that made the deal undesirable from us, even though we believed in the management, even though they showed some demonstrated track record. So the conversations we had when you came into the UWM Innovation Incubator is that sometimes this is a little more of an art than it is a science. But those are some of the factors that we kind of look at when we're evaluating, some of these deals. First, it's his management. Second, are you getting some type of traction? If you don't have revenue, sometimes what you can do is you have IP. So we invested in a company out of Madison that has a really strong portfolio of IP. But behind that, it's intrinsic value that we believe in the future, a pharmaceutical company will value highly and want to purchase. Yep. So that's kind of my 2 cents on that. Hopefully it provides some context for those earlier stage companies that are not even generating revenue, let alone free cash flow.
Yeah, definitely. And then I included this supplementary slide that kind of shows a pretty basic DCF, but it assumes an upfront cash burn, kind of what you're going to typically see, with break even at around year 5, typical of a venture capital kind of holding period, followed by really the rapid scale of free cash flow as they reach that critical mass in terms of customers, and they really start to expand their margins. But this basically, I was just playing with the numbers just to get to kind of what justifies mathematically a 10x revenue multiple. And you can see there's a significant amount of growth that's required, especially upfront. And again, you could play with the inputs and get to far different answers. But yeah, you change a simple, like one of these numbers, and it'll change your present value, and that revenue multiple that you're willing to pay changes it pretty dramatically when you play with that analysis. But that's kind of gets to your point of how difficult it is to come in at a high revenue multiple, and kind of what's the math behind that. What does it imply?
Well, what's interesting about that is I think there's a dichotomy in viewpoints. And again, every angel group and every VC has different perspectives on this. Some VCs come in and say, we want you to grow at any cost because we want you to get revenue up. My humble opinion at the end of the day is your business has to generate free cash flow at some point in the future. So it's a balancing act, because if you don't, you're going to essentially run out of money. Right. So I think, and where that is in the future depends. So I think growth at any cost, at least from my perspective, can be a dangerous value proposition. Yep. And what's interesting is that I think the pendulum, I've been doing this for a few years now, the pendulum swings both ways. So when we're in a bull market, whether it be in stocks or bonds, it seems like individuals are more interested in writing checks. When we're in a bear market, whatever that might be, in both stocks and bonds now in 2020, the risk perspective decreases a little bit. So it's kind of an interesting situation. I think, are seeing valuations at lower levels, which is good for the angels. And I would argue sometimes it's maybe beneficial to the founders as well. So they're more conservative in the approach that they have. Now, as we go into 2023 and 2024, and we right the ship in terms of wherever interest rates are going to land, and then nominal GDP growth is going to occur, that might change. So that might be a different story in 2024.
Yeah, very interesting.
So we have a few people on the Zoom call. If anybody has any questions, you can certainly type them into the chat. This will be recorded as well, and we're going to post it out on Milwaukee Venture Partners website as well for those individuals that weren't able to attend today.
Then, yeah, as I said, there are, and are you going to share the presentation as well, Matt?
If you're comfortable with that, that would be fantastic. Yeah.
Yeah, we could share the presentation. There's hyperlinks throughout the main slides that take you back to some of these supplementary slides, along with, like there's a more explanation on a free cash flow, VC required returns, kind of the academic support for that, bringing us back to the relationship between high growth and value. This is that DCF I just showed, some data on failure rate that's supported by academic studies. There's actually a really interesting, this is actually on the bottom right, there's an external link to a website by CB Insights that takes a different view than this, but kind of gets to the same place, where it looks at attrition from a single cohort that I think included Instagram and a few other notable startups or unicorns that eventually made it big. And they were like 3 out of 1,000, I think, unicorns in that group. And it kind of, so that's an interesting little external thing. And then this was convertible preferred stock. I'm sure most of the audience here is familiar with how that generally works. But yeah, so decent amount of information in here aside from just what's in the presentation.
Excellent. Zach, any final thoughts before we end the call here and end the recording?
No.
I'll provide the slides and I'll provide your contact information. So I appreciate you presenting this and helping us educate on the various ways that we value companies.
Yeah, no problem. Yeah, no, I don't think I have any final thoughts. I feel like we've covered quite a bit here. in a short amount
Yeah.
of time.
All right, unless there's any questions, I'm gonna thank you again, Zach, and I'm gonna stop the recording here. And then for all the individuals, we will post this out on Milwaukee Venture Partners website, and then we will certainly share that as well through various social media channels that people can revisit this if they find value in it. So
Okay.
I'm gonna stop recording here.